is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London, and here's what's coming up on today's programme. Fully charged, Tesla's profits beat estimates, and CEO Elon Musk pledges to accelerate output. Closing ranks, President Biden commits to sending advanced tanks to Ukraine as part of a broad allied effort to support Kyiv in its fight against Russia. Plus, a new survey says business confidence in Britain has fallen to its lowest level since the financial crisis. We discuss in 30 minutes' time on Bloomberg UK. Let's check in on these markets. There is optimism, there is enthusiasm, and a lot of that is coming through from Hong Kong, the reopening after the Lunar New Year holiday, and some of the evidence on the ground around travel, around box office receipts, suggesting that there is this pent-up demand, and you're seeing that reflected, and you did see that reflected in Hong Kong stocks. The mainland remains closed. So that's feeding through into a positive session for Europe. You also had the Bank of Canada suggesting and flagging a pause in rate hikes. What is the recross for other central banks? Again there on the benchmark, 0.5%. Of course, it's earnings season as well. So we had some beats from the likes of Diageo, SAP, ST Micro, slightly different stories for Volvo. Those come through and are playing out across these markets. Nasdaq futures pointing to gains of 0.6%. Yes, it was a beat for Tesla. Expectations you could get 1.8 million to possibly 2 million deliveries this year. Euro dollar 109, just down 0.1%. The Bloomberg dollar index just come back a bit in the session. Of course, the trajectory has been lower for the greenback. Does that continue? That will be tied to what happens with the Fed, of course. And UK gilts are 324. Just looking at the debt markets here in the UK on the back of that survey, finding that business sentiment has ebbed again. Of course, importantly, money markets starting to price in a 25 basis point cut from the BOE by the end of this year. Let's check on the map then and see how this is playing out across the European space. You can see the strength coming through over in France, particularly in Italy. The FTSE MIB up 0.8%. The CAC 40 gaining 0.7%. Yes, we're seeing some green on the screen here in the UK. It's slightly more muted, though, down currently up 0.2%. At the top of your list in terms of your sectors, technology gaining 1.3%. Just three sectors in the red: food, beverage, utilities and real estate, which is currently range-bound. Now, investors' attention turns to a big haul of data from the US this afternoon, with the focus on the latest reading for GDP. For more, let's bring in Laura Cooper, Senior Investment Strategist at BlackRock International. Laura, good morning. How focused are you on the GDP print? It's to some extent backward-looking. What does it tell us about the resilience of the consumer in the US?
And that's the key question that we'll be watching for in the data, because I think the interesting trend that's come through in the US is this divergence between the forward-looking sentiment gauges like those ISM, like CEO confidence plummeting. But we have yet to see that in the hard data. So right now we're tilting more towards the hard data, and I would expect the Q4 print is going to show a slowing. But when we strip out the consumer spending component of that, net trade is likely to be a contributor, as well as inventories. And those two factors suggest to us that the domestic economy is slowing, and really underpins our view that this is showing increasing signs of deterioration that sets up for a U.S. recession this year.
OK, you do think there is going to be a U.S. recession. Give us a sense now, give us an update in terms of the flavour of that recession.
Well, it's probably what we've heard from consensus more recently around this short and shallow recession, because we are starting from a relatively high base. But this is still a Fed that, yes, they're likely going to pause at the end of Q1, potentially early Q2. But this is still an environment where we are at elevated policy rates. They're going to keep rates at restrictive levels for some time. So we do think that sets up for a contraction in Q2 and Q3, about a 1% peak to trough drop, driven largely by those interest rate sensitive sectors, manufacturing, business investment, and as well the construction side. So we're waiting to watch that.
1% peak to trough.
Yes.
How interested are you in what we've heard from the Bank of Canada flagging a potential pause? How much of a signal is that? Or is it idiosyncratic to the Canada situation?
I think it's a little bit hard to read through the Bank of Canada experience to what we expect to come from the Fed and the ECB and others. But what was interesting in watching Tiff Macklem's press conference yesterday was his emphasis on this is indeed a pause. They're waiting to see the evolution of economic data as those earlier rate hikes feed into the data, rather than signaling the end of the tightening cycle. So I think that's really the important takeaway, that there is still a great deal of uncertainty around the policy path going forward through this year. Inflation is still elevated. We're
Yep.
starting to see some economic data come through of deterioration. So there's still uncertainty on the policy paths.
When it comes to these stock markets, I mean, the gains again today and the rally, of course, year to date, or in fact, since about middle of September. Was October the low for these equity markets? Was that the bottom? Are you becoming more convinced of that, or is the fragility there that it could dip back below that level?
Well, I think from our view, we're still seeing developed market equities as vulnerable, largely because, notably, if we look at Europe, we think a lot of the rally year to date is front-running some of the positive news. So we have this better-than-expected outlook on the back of those easing gas prices. We have signs of peak inflation coming through. We also have that China reopening. So really these key tailwinds. But we struggle to see what the catalyst is for a further leg higher. Notably, when we look at earnings estimates, the fact that we do still see a European recession come through. Yes, the tail risks of no recession are widening, but that overlaid with the fact that earnings estimates still remain positive, we see that divergence as coming to a close at some point. So we do think earnings have more room to go lower.
Is there an income, earnings have more room to go lower? That's important that you pointed and flagged that. Is there an income strategy play in Europe, though? I'm thinking dividends, I'm thinking buybacks. Is that an area of optimism? Is that a potential catalyst?
That certainly is an area of opportunity. And I think it's about approaching European exposures through a very selective approach, finding where they could potentially have further upside. So certainly dividend, that income quality tilt of equities is where we're seeing flows as well in terms of investor positioning. But as well, it's looking at, the energy sector that we do still think has some structural support going forward. But we've actually done an interesting analysis more recently, looking at European exposures to China and the reopening play. And we find that, travel, consumer discretionary has the highest sales revenue exposure to China's growth, but as well kind of the basic resources. So yes, slightly different this time around because we do see it as more of a consumer-led reopening in China rather than investment-led. But we do still think there's going to be positive spillover effects to European equities.
What's your assessment of the earnings so far that have come through? It's early days, but we've seen some of those numbers come in. Has it aligned with your expectations?
I think there's probably an interesting trend that's emerged that caught my eye, and that was the sense that we are seeing rising mentions of wage pressures, wage inflation in Europe at near historical highs, but yet coming through the U.S., we're actually seeing that dissipate. So that's an interesting trend because when we look at what CPI inflation data is telling us, it's suggesting that core services inflation in Europe is remaining stickier than expected, but we are starting to see that decelerate more quickly in the U.S. So it's interesting to note that what that means for the ECB. Could they actually have scope to continue hiking beyond what the terminal rate pricing is now? Because there are these risks of the second round effects to wages. So that's something we're closely watching for in this company guidance.
We talk about tech in broad brush strokes. It is, of course, a multi-layered sector. You look at the likes of ST Micro, very solid earnings. ASML was a beat as well. What do you need to see? What is the trigger point for turning more positive on technology, and where would you turn your firepower? Is it the hardware versus the software, for example?
And this has been a key question and a key debate, certainly on our team over at BlackRock, because largely if we think about the near-term pressures are quite evident. So if we think about, we have seen the cost cutting come through from these companies, but it's the top-line growth that they're going to have less of control over. And that, against this backdrop of a weakening demand, we do think is going to have further squeeze on margin pressures. We do think that's going to be a key headwind for the sector. But as you mentioned, kind of looking longer term, more of a strategic basis, we think these could potentially be attractive valuation entry points, but it's being selective. So looking at those semiconductors, those artificial intelligence, cloud computing, where we still think there's going to have those structural supports from that automation. We have that policy tailwind. So I think there are opportunities, but it's about your timing and it's about being quite selective.
Timing, being picky, being selective. Laura Cooper, always excellent. Thank you very much indeed. Of course, senior macro strategist at BlackRock International. Thank you. Now, coming up, Tesla shares jumping in pre-market after better than expected profits in the latest quarter. The tech giant also sees more deliveries this year. We bring you the details. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Now, Tesla has reported better than expected profits in the latest quarter, even as it gave mixed signals on the outlook for growth in vehicle deliveries. Joining us now is Bloomberg's Craig Trudell, who covers all things global autos. The key takeaways for you then, Craig, the market is responding with optimism to this.
Yeah, it's interesting because we are used to Musk being overstated.
Yeah.
I thought it was for him it was kind of an unusually understated performance on the call. I think he of course did make some big proclamations and talked about the idea that you couldn't see Tesla's competition in automated driving with a telescope, something to that effect. And yet, he was, emphasizing the risks that Tesla faces this year and the challenges. And so, they talked about this idea of targeting 1.8 million units for this year. Later on the call, 2 million units. But they sort of, caveated that 2 million target or internal target as, something that they're reluctant to sort of cling to just, because of all of the challenges that they see out there and the unpredictability of where we are.
And getting to 2 million is going to come down to some of the price cuts. We talked about this yesterday. Yep. There's the payoff, of course, in terms of the margin squeeze. But Musk talked about the importance of those price cuts and what that's doing to accelerate or at least maintain demand.
Right, and he did talk about a big pickup in orders, but I think, we only saw, the first little taste of how those price cuts are going to affect the bottom line, because we really only saw, the first of 2 rounds of cuts in China in the fourth quarter. The second one came in the first quarter. We saw some discounts in the U.S., but, again, much more drastic cuts early this month. So, it remains to be seen, just how willing he is to compromise on profitability in order to keep the growth going. That seems to be what his move is going to be here.
One criticism has been that they don't have new models in the pipeline. Yeah, we're waiting for this truck. When is that going to come on board? Is there an issue about the fact that they're not designing and putting new pipelines in the model for this business?
I think it's interesting in that, the reaction is so positive, and yet one of the things that stood out to me was them kind of, playing down how much of a role the Cybertruck will play in 2023. They really sort of talked about that being more of a 2024 story in terms of when they'll actually get volume production of that. I think, there is some criticism that, there's no way that these guys are going to be able to keep growing with such a limited lineup. But I think Musk has sort of talked about this as being very strategic, and that, in this time of supply chain issues and complexities and procuring batteries and lithium, having a simpler model and, sort of concentrating your volume on just a few models actually can be an advantage. We'll see how much further he can take that.
This is the cautious side to Elon Musk that you don't see very often.
Very unusual.
Just briefly, he gave a nod to this. He said, our main competitors are probably not going to come from GM or Ford, the US or Europe. They're going to come from China. And we have a big take on the ability for China and the fact that China is exporting more and more cars, XPeng, NIO and others. How consequential is this?
I think it's interesting because, Tesla is very much a participant in this story too, right? Where they are exporting a whole heck of a lot of vehicles into Europe from the Shanghai factory that they opened a few years ago. But they are on the other side of it, both a participant and this is a threat, right? So BYD very much has ambitions to not only be a huge player in their home market, but really expand overseas. You're seeing, other Western brands, follow Tesla, BMW, Volkswagen, Renault. We're going to see a combination of Western brands taking advantage of the low-cost base of China and exporting some models to markets, including here in Europe, but also, the BYDs, the NIOs, the XPengs. Really, don't just want to, keep their ambitions to their shores. They want to look elsewhere as well.
Okay, watch this space on the China challenge there around the production and export of vehicles. Craig Trudell, thank you very much indeed. And of course, on that beat for Tesla. Let's get to the Bloomberg First Word News now with Laura Wright. Laura.
Thanks, Tom. The New York Stock Exchange has blamed manual error for the wild price swings and trading halts at Tuesday's market open. Bloomberg understands an employee failed to properly shut down the company's disaster recovery system before the open, causing the problems. More than 1,300 trades and some 84 stocks were impacted. Meta says it's reinstating former President Donald Trump's Facebook and Instagram accounts following a 2-year suspension. Trump was banned after the company deemed that some of his posts had encouraged supporters to invade the US Capitol in January 2021. Meta now says it doesn't want to get in the way of an open debate and that Trump will face tougher penalties for any repeat offences. According to a survey of accountants, UK business confidence is at its lowest level since the global financial crisis amid recession fears and persistently high inflation. Companies in retail, property and manufacturing sectors were particularly downbeat. Separate data showed car makers in the UK had their worst year since 1956. The global chip shortage and the closure of key factories hampered output in 2022, leaving it well below pre-pandemic levels. A change at the top of the world's biggest car maker, Toyota, is promoting Lexus president Koji Sato to become the group's CEO. Sato's job will be to guide the Japanese company through the challenges and electrification and automation. Toyota, who is the grandson of the company's founder, will become chairman. Global news 24 hours a day on air and a Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg Tom.
Laura Wright here in London, thank you. Coming up, the US has confirmed it is joining Germany in sending main battle tanks to help Ukraine counter Russian forces. We'll unpack the rationale and the potential implications next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. The US will send Ukraine 31 of its M1 Abrams battle tanks. That is adding to a German commitment to supply some of its top-line armour. After a lot of pressure, of course, US President Biden emphasised unity in supporting Ukraine.
I've been saying this for a long time. The expectation on the part of Russia is we're going to break up. We're not going to stay united, but we are fully, thoroughly, totally united.
OK, let's bring in Bloomberg's Ross Matheson for more then. Ross, Scholz and Biden finally aligning on this issue. We heard from the president there saying, look, this is a message ultimately to Putin that NATO and its allies are not going to be divided. How central was that in this decision?
We can see that important messaging yesterday, and of course Joe Biden also praising Olaf Scholz, publicly saying he'd stepped up when called upon. But it took weeks to get here, and there was a lot of disunity on display in the process. You saw pressure from Poland, from Latvia, from other countries on Germany to say, come on, we need to send our Leopards. You saw messaging really from Germany to the US, which is we have to move together. If we're going to send our Leopards, you have to send your Abrams tanks, which the US was really, really reluctant to do. And you could see the evidence of the disquiet that was going on in the communications between European nations within NATO and the US. So now we've got a message of unity, and certainly there is an overarching desire to keep supporting Ukraine, particularly as this war enters the one-year mark, particularly as Russia may be gearing up for a fresh offensive. But you can actually see some of the cracks that are starting to show, and that must be worrying Ukraine.
And we've seen how this has evolved. We go back to the HIMARS, that pressure for that rocket system from Ukraine, and Western allies say, no, we're not going to do that. There's too much of a risk of hitting Russian territory. Then they relented. Then there was the pressure on tanks. Then they relented. The front page of the FT today, there's a picture of an F-16 around the debate about more offensive weapons. Is that the next step? If fighter jets, the next logical conclusion?
Well, that will be the discussion. You can see that Ukraine is always asking for more, and quite rightly so. And when they get something, they want another thing. And they've been calling for fighter jets since the war broke out. They've been calling for air defence, an air defence zone since the war broke out. They've been calling for very long-range missile systems since the war broke out. And they've got some of that stuff, but they haven't got Western-made fighter jets. They haven't got an air defence zone, and they haven't got the very longest-range missiles. So you can expect Ukraine will keep pushing for that. Those things are probably another level, again, of caution, because fighter jets, who's going to fly them? Who's going to train them? Do you end up with sort of a scenario where NATO is, in effect, involved directly in this war? And if you supply Ukraine with weapons that allow it to strike deep in the heart of Russia proper, that will be seen by Russia as a direct attack by NATO. So certainly that's a very high bar to get over from here.
That's the high-risk conundrum, isn't it, for these policymakers? And we touched on this yesterday. It's the time frame, particularly around this potential April offensive. You said it may come even earlier. And then we got a bit more detail in terms of when these tanks are going to be delivered. And it doesn't seem like they're going to come on board in field, at least for 3 months. So what does that mean in terms of the tactics on the ground?
We have to imagine that this gives a window potentially to Vladimir Putin if he is indeed mobilising for a fresh offensive, that if he wants to do that next month or in March, these tanks won't be there then. I mean, you can expect fierce resistance from Ukraine no matter what. Russia has really struggled not just to sort of take ground, but then to hold it. But without these tanks, without these weapons, you could see that Russia might think that this is now the opportunity as the terrain improves, as the weather improves, to make a push, knowing that these tanks are coming. If you're in Russia, you're thinking, well, this is my chance.
Ros Matheson, always excellent. Thank you, of course, for the latest on that decision then by the US and Germany to align on that delivery of tanks and, of course, what it means for the Ukrainian forces. And, of course, we continue to watch for a response from the Russians. We did hear from the press secretary, at least one of them in Moscow yesterday, suggesting that they are not too concerned about this. Whether that's a reality is another question. Coming up, UK business confidence drops to the lowest level since the global financial crisis. We discuss what is driving the gloomy outlook. That is next. These markets up 0.5% here in Europe. Futures in the US higher by 0.2. This is Bloomberg. Good morning and welcome to Bloomberg UK, a new show with a special focus on the biggest challenges facing the British government, economy, financial services and markets. I'm Tom Mackenzie in London. On the show this week, a new survey says business confidence in Britain has fallen to its lowest level since the financial crisis. We look at how persistent inflation is shaping boardrooms and the British economy. Also on the show, the UK's energy system is under renewed pressure with cold weather and a lack of wind generation. We discuss with Bill Bullen, CEO and founder of the energy supplier Utilita. Plus, UK chips. Sources say the government will subsidise domestic semiconductor firms to ramp up production at home amid global supply concerns. So, UK business confidence, yes, it has sunk to its lowest level since the global financial crisis, of course, of 2008-2009. A survey by the Institute of Chartered Accountants found companies in the manufacturing, property and retail sectors were particularly downbeat. They cited persistently high inflation and fears that the UK is already in a recession. Does that not spell stagflation? For more, I'm joined by our UK business reporter, Saber Meddings. Also with me is Bloomberg senior reporter John Stepek, who writes the weekly, monthly distilled newsletter. John, let's start with you. Gloom and doom across the UK. Business confidence is crushed. You say it's not as bad as it looks.
Yeah, I mean, look, this is entirely understandable. Business confidence is low. Consumer confidence is low as well. There are lots of things to be worried about, and the headlines are constantly saying how bad everything is. But one thing I think is really important to remember about this particular survey is it was taken between October the 12th and December the 12th. Now, I think we all remember that that was a particularly turbulent time, and the honest truth is that things have got better since then.
Where are you seeing silver linings? What's gotten better?
Well, basically, if you look at all the... So before Christmas, I don't know about you, but certainly lots of people, and myself included, were sort of thinking, well, you know, this could go really pear-shaped this Christmas. You know, we could see all the trading updates in January, and it could be kind of really bad news. And the honest truth is it hasn't been. A lot of companies have come out and they've beaten expectations. In the last week, we've had all the airlines, EasyJet, Wizz Air, Jet2 today, saying that they've, you know, absolutely trounced expectations. It's... A lot of people don't seem to want to hear it, but consumers still have money and they are still spending it. And as long as that continues, and as long as people hang on to their jobs, the UK economy, which is driven by consumption, is not going to do as badly as perhaps we expected even 2 or 3 months ago.
Saba, let's bring you in at this point. It's also looking good if you're a CFO, and you've written about this. It's a lovely piece, really fascinating, some of the individual moves across companies, but it's in the importance of the chief financial officer at a time of tighter financial conditions. Talk to us about what is happening to CFOs in these executive suites.
Well, if you talk to the search firms, Spencer Stewart told us that searches are up 30% over last year. So there's enormous demand for CFOs. I think what's happened over the crisis is people have you've got through COVID, you've managed it, you've put your staff on furlough, and now you're thinking, who can lead us through the next crisis? Who's going to be able to allow us to invest in growth while at the same time really helping the CEO drive the organisation? It's not just about number crunching anymore. It's about operations. It's about conversations with lenders. It's about making sure that people's balance sheets are really strong. The CFOs are now one of the most important people.
Not just the bean counters, but it's about transformation as well. Chief transformation officers as they align to some of these challenges. Talk to us about some of the big moves and talk to us about how challenging it is to find this talent.
I mean, if you think about it, the average age of a FTSE 100 CFO is 52, so very few of them have actually lived through a period of crisis, period of high inflation like we're seeing today. So it's difficult to find people who've got that experience of kind of having that finance experience, but also having been in a sort of a boardroom in a time of crisis. So that's what's keeping people up at night, I think. OK,
John, on the question of inflation, it was interesting we saw, because of course CFOs had to wrestle with this, how to maintain margins in a higher inflationary environment, in a recessionary environment. We had some data that came through this week that suggested that inflation, at least in some areas of the UK, is actually starting to ebb down. I know you've been doing a deep dive on this as well. And this is another one of your silver linings.
Yeah, I mean, factory gate inflation, so what's technical term, producer price inflation. So basically raw material costs have actually plummeted in the last year. So all the things that have driven inflation up that were the result of the pandemic rather than kind of more longer term trends are now collapsing. Shipping costs are down about 75% year on year. Wholesale gas and electricity prices, the things that are affecting our energy bills, they've halved based relative to the forecast made by the OBR in November. Now that's all good news because, well, two reasons. It means that inflation in the pipeline is coming down, which means consumer price inflation is likely to come down faster than expected. And it also means that the government's finances aren't going to be as bad, which means potentially, might happen, don't know if it will or not, but in the March budget, Jeremy Hunt might be able to turn around and say, actually, you know, maybe we're actually going to cap energy prices at $2,500 per household rather than the $3,000 which is currently planned, or do something else that introduces a bit of stimulus or a tiny taste of tax cuts, which would be very welcome.
It would indeed, wouldn't it, for many people. Simon French, Panmure Gordon, you can have a shout out to him in your latest newsletter.
Yes.
He's pretty clear that inflation has peaked. Talk to us about the rationale then. Inflation peaking in the UK, it remains a bit of a debate elsewhere.
Well, I don't know if that's necessarily true, actually, because, well, I mean, in the US, it's certainly, I mean, you can never say certainly, but it peaked a while ago. October was the peak for the UK. We're still at double digits. I mean, none of this is to say that, I mean, the other thing to remember, because people get annoyed about this, but the inflation rate falling doesn't mean prices are going down. It just means they're going up less fast.
Yeah.
So mathematically, anyway, prices were almost certain to come. Sorry, price inflation was almost certain to come down this year. But the point is, if it gets down to say, I mean, for example, Simon French kind of reckons we're talking about 5% odds by the end of the year, and kind of closer to kind of the Bank of England's target by the end of 2024. If that's the case, the bank has every excuse it needs to not raise interest rates any further than markets currently expect. And for everyone who's worrying about their mortgages, by the way, that's 4.5%, possibly even a tiny bit less. And even, I mean, our own team in Bloomberg Economics kind of wrote the other day, actually, a recession is not nailed on for the UK in 2023. You know, we've all been talking as if we're already in recession. So, I mean, I honestly think the outlook is just that little bit less bleak than everyone thinks. And that's where that disconnect between confidence, which sort of reflects the headlines in the sense of uncertainty, and the actual results that are coming out, that's what that's stemming from.
And you touched on the BOE and the money markets yesterday pricing in a cut by the end of this year from the Bank of England. So we'll see if that transpires and what that would mean then.
That I'm less
convinced about that.
But even if they leave it at 4.5%, you know, people are going to sweat less about their mortgages because mortgage rates have been coming down as well. Because the mortgage
what
rates
are they, 6% now?
No, they're kind of down below 5% now.
Okay.
You can quite easily, in fact, I saw a 10-year fix for 3.99% yesterday. I mean, I'm not saying you should fix your mortgage for 10 years, it's up to you. But I'm just saying it's nowhere near as bad as it was 3 months ago.
Okay, Saba, there's a big focus here on the UK, obviously, and in terms of what CFOs are doing and the changes at the boardroom level. Are you seeing that across Europe as well? Is it idiosyncratic to the UK, or is this a broader picture in terms of boardroom changes and the focus on someone who can navigate these changes?
It's definitely across Europe. Those Spencer Stewart figures, that was for EMEA. So definitely, I think there's sort of changes, people looking for someone to upgrade. So certainly across Europe, the picture is very similar.
Are they able to hold on to the talent here in the UK? Is the UK a less appealing place to be a CFO, to be navigating these challenges, or is there temptation to jump ship, move somewhere else?
I think it's true of both CFOs and CEOs. There's a lot of focus on remuneration in the UK. Paying people what they think they deserve is a real something that if you speak to chairmen or women, they might complain about that as sort of the lure of going to the US. You get much higher multiple. You maybe don't have as much pressure from shareholders about keeping pay down. So certainly pay and you know, just greater scrutiny over governance is certainly something that people will grumble about in the FTSE.
Really, really interesting. Worth reading Saba's reporting, of course, always John Stepek's newsletter as well. Thank you, our UK business reporter, Saba Meddings, and, of course, Bloomberg senior reporter, John Stepek. But thank you both. Coming up, we're going to speak with Bill Bullen. He's the CEO and founder of energy supply Utilita. It's one, and it is focused on the challenges facing the UK's national grid. That is next. This is Bloomberg. Economics, finance, politics. This is Bloomberg UK. I'm Tom Mackenzie in London. Now, the UK has been paying some consumers to reduce their energy usage as a cold snap and weak wind put supplies under pressure. More than 1 million households and businesses have signed up to the scheme, which is expected to cost £3.5 million over 2 days. I am now joined by Bill Bullen, who is the founder and CEO of UK energy supplier Utilita, and Rachel Morrison, who leads Bloomberg's coverage of power, gas and renewables. Rachel, let's start with you. How unusual is this, and is it having the desired effect?
Well, with the consumer demand, it's the first time that National Grid has used it this week. They sort of thought about it a few weeks ago in December, but, you know, it is a big moment. It's a scheme they put in place for this winter to help balance the grid when they knew things could possibly get tough. But what's interesting about it is that it's only certain households who signed up to the scheme. It's not everybody. So there should be more of this going forward. You know, they're using it as a test case to show that people and home energy use can have a difference in bringing it down demand when it's not windy and when they need to kind of fine-tune the supply and demand balance.
And we talk a lot when we assess the economic health of the UK, but also Europe, of how and the fact that we benefited from a slightly warmer winter than many had expected. But we have had this cold snap, and now National Grid, as well as paying people, or at least as well as people being paid by the UK government, there is also coal-fired power stations being put on guard, at least basically being told, get ready, you may need to step in with extra supply.
Yeah, that's happened 3 times this week that they've asked this reserve of coal-fired power stations to warm up and get ready. They haven't used them yet, but it's a sign to the market that, you know, they're worried about supplies. It's been in the evenings, and that is largely down to a drop in wind generation. I mean, demand has been higher, but the UK is increasingly exposed to those troughs in peak in wind generation, and that's as we build more and more, which is great, gives us lots of green energy. We also need backup for whenever it's not so windy.
And the backup is dirty energy. OK, let's bring in Bill Bullen at this point. Bill, how broken is our grid system? How much strain is on our energy sector at this point?
I think that actually the electricity system, you know, right now is not actually in too bad a place. I think the key thing that NGC were trying to prove with this demand response was to, you know, basically to prove that it was possible. You know, this is a trial that's been going on all winter. We didn't actually get involved in the initial trial with NGC because we were concerned that the rewards people were given weren't going to be enough. So we actually ran our own trial with slightly higher rewards. But actually, it turns out that, you know, people have been responding to the signals that NGC put out. And, you know, as I say, they've proved that this is one way of balancing the grid in the very short term. I think it probably begs the question whether, you know, the novelty will wear off, whether the earnings, are going to be quite enough to keep people switching off, but certainly is an option for helping to balance the grid. As was said by you just now that, we are going to have a grid that is likely to have these balancing issues more often as we have more renewables on the system.
Can we just pursue that line of thinking a little bit? Because yes, we have people being offered financial incentives to reduce demand, but the argument against the government's support around putting a cap on energy prices, and that's going to be adjusted in April, is precisely that it doesn't lead to an adjustment in demand that you would otherwise get, those market forces. Do you expect to see long-term households and businesses adjusting to these irregular supplies?
Well, businesses and households have definitely responded to the higher energy prices that, we've seen over this winter. There's no doubt about that. We've seen on average about a 15% reduction after having allowed for weather effects. There's a huge question of affordability. I wouldn't say this was a price response exactly, because basically people just haven't had the money. Whether we will actually see a long run impact from having these high prices because people invest more in their homes, particularly in insulation, low energy light bulbs, all of the things that we know are cost effective things to be doing. Remains to be seen, but we certainly have seen an effect, a price response effect of some sort as we've gone through this winter.
Bill, what are the structural changes? You're quite vocal on this. What are the structural changes you want to see within this industry around prepaid meters, around the way that we monitor our energy use?
Well, I guess, the key thing that I think this is confusing everybody right now is that we've got all this renewable capacity coming into the system, and yet it's still priced at the same price as, very expensive gas plants right now. And I think if there's one thing the UK needs to do in terms of changing the way the market operates is to make sure that the renewable generation that, we've all been subsidising up to this point actually gets through to consumers at a far more reasonable price. There is a ROC scheme, a renewable obligation scheme, that pays, a subsidy on top of market price, and consequently market price has gone up, but the subsidy is still being paid. So the scheme overall has been very successful in getting renewables onto the system, but at the same time we cannot have a situation where renewables are getting priced at the same price as very expensive marginal thermal plants. It just doesn't seem equitable, given that for long periods of time.
Yeah.
Sorry.
I just want to get Rachel's views on that, because of course she's close to policymakers and regulators on this issue. Are you seeing any movement amongst officials in Westminster around addressing that particular concern? And then folding in a second question, as you look longer term, what is the energy demand picture looking like throughout this year for the UK?
Yeah, marginal pricing, which is what Bill was describing there, is something that's being talked about. The UK is looking at reforming electricity pricing for exactly those reasons. And in Europe, it's a big question as well. The problem is that this marginal pricing system has been in place for decades, and it's difficult. People have got financing based on the system as it's set up. So changing it is difficult. And when you look at the alternatives, there isn't anything that's, a front runner particularly. It's all quite tricky, and unintended consequences is something that people are very worried about. But we know that power demand is just going to grow as we electrify everything. And some of the things we're talking about, it seems like the tipping point for people to care about this stuff and their energy use will be getting an electric vehicle, which is something we know, demand is growing for hugely. So once you do that, you start thinking about your energy use a lot more, and you will pay much more attention to when prices are low, when prices are high, because you will charge your vehicle. So things like that will start to mean that people care a lot more about this stuff. But we do need to sort out the pricing to make sure that people can take advantage of those peaks and troughs in the prices.
If they don't care now, then I wonder what is going to make them care. It's woken us all up, hasn't it, to the cost of energy. Bill, briefly, before we let you go, we saw a string of bankruptcies last year amongst smaller utilities here in the UK. How well positioned are you and the team at Utilita to weather the challenges ahead? How much pressure is there on your business at this point?
Look, all businesses are under pressure. The main pressure on Utilita right now is the prepaid price cap, which, I've said on a number of occasions is forcing us to run at a loss. But, at the same time, we run a very robust business, and, we're not concerned, particularly now as we come into the period where energy prices are starting to fall back. So we think we've weathered this storm. But, Ofgem does need to address the issue of, the cost of running a supply business, especially since they keep adding new obligations into supply businesses, especially when we're talking about vulnerable customers, which is very focused in the prepay area. So, we have got some challenges going forward, but I think Ofgem is looking at these issues. It's really a question of funding, and the problem we've all got right now is that even the government has got its affordability crisis. You mentioned earlier on about the energy price guarantee going up to £3,000 in April. I mean, that's going to feel really weird. Everybody's going to be reading about wholesale prices going down, and at the same time, retail prices going up. So that's going to be a difficult message to get across to people, because obviously on the surface of it, it might seem like energy companies are profiteering. They're absolutely not. This is the change in government policy that's going to cause that price change.
OK, Bill Bullen, really, really important insights. Thank you. Founder and CEO of UK energy supplier Utilita, and Bloomberg's Rachel Morrison, of course, across the energy space for us. Thank you both. Coming up, the UK's chip push. Sources say semiconductor firms will get direct funding in a new strategy to bolster domestic production. We have the details. This is Bloomberg. Welcome back. Bloomberg has learned that the UK government is to provide direct taxpayer funding to support domestic semiconductor companies. This as part of a strategy for a sector that has become, of course, a lightning rod in global geopolitics. Let's bring in Bloomberg's Ross Matheson for more. Ross, how much is the UK coordinating with the EU on this, and what money are they putting to work?
Well, that's the question. How much are they coordinating? Because the UK, of course, post-Brexit is keen to do everything really on its own. And the EU is sort of like working together, perhaps without the UK on this. What we're seeing in the broader frame is that the pandemic, now Russia's invasion of Ukraine, has shown countries the need to think about their supply chains, a lot of push towards reshoring, and certainly the US-led effort through the IRA to sort of bring industry back. And the UK is reacting to that. The EU is reacting to that and saying, hang on, we need to secure our chip supply in particular. So the EU is working together. The UK is working on its own with this new funding plan. And you can see the opposition politicians in the UK are saying, hang about, are we talking with the EU about this? Because we're too small to build this industry on our own, and we need to be coordinating. So that is the question. How much is the government working with the EU on this, if at all?
I mean, given the financial constraints that this government is facing, it seems pretty ludicrous that they wouldn't be coordinating. We'll see if that evolves. How much of this is about Taiwan and the vulnerability of TSMC?
Well, that's right. A lot of countries have woken up to the fact that they're very, very reliant on Taiwan for a large part of their chip supply, from the very basic chips, but also through to the more advanced stuff that TSMC has been producing over the years. And the chip industry in many other parts of the world is quite small, quite niche. It's focused on very high-end or on mass production, but Taiwan does it all. And of course, the war in Ukraine has shown again the potential for countries to become vulnerable. And China looks upon Taiwan as its own territory. It is, of course, a democratically run island with its own government. But China has a long-stated goal to what it says reunify with Taiwan, and that's raising the stakes about the stability of Taiwan going forward and the security of supply.
Big questions, of course, about this funding, this support from the UK government. Ross Matheson, always excellent. Thank you very much indeed. Be sure to subscribe to Bloomberg's In the City podcast, hosted, of course, by Francine Lacqua and David Merritt on Apple Podcasts, Spotify, wherever you get your podcasts. The markets here, the FTSE 100 gaining 0.2%, futures in the US up. Stay with us. This is Bloomberg.
Earnings have been running, sort of well above trend levels.
I think there's a broader war on Wall Street right now in a juxtaposition between the top line and the bottom line.
I think there's continued earnings risk as we move through the year.
Look, we've got very pessimistic expectations. I think everyone is saying, look, earnings expectations are still too high. I don't disagree with that, but I disagree with the sequencing. I disagree with the timing.
This is Bloomberg Surveillance, early edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Tesla ramps up production after reporting better than expected profits. Elon Musk's electric car company plans to deliver 1.8 million vehicles this year, a 37% increase. Asia's richest man fights back. The Adani Group considers legal action against the short seller who accused the billionaire's empire of market manipulation and fraud. And the culprit in the chaos at the New York Stock Exchange, Bloomberg's learned it was a staffer who left a backup system running when it should have been shut down. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. So Kailey, the NYSE with its own version of the turn it off and on again problem. But back in markets, things looking a little bit more positive than they did over the last day or so. Although we've had, yes, there's Tesla, but a mixed set of earnings otherwise.
Yeah, that's very true. You definitely have a variance of stories when it comes to earnings season broadly, Anna. But as you say, it was mostly a positive day, and that includes Asia, where a lot of markets were back open after the Lunar New Year holiday. China is still closed, but Hong Kong was trading once again, as was South Korea. Japan, of course, has been open the whole time. So I can actually talk about the MSCI Asia Pacific Index as a whole, and it seems fair today. The MSCI Asia Pacific Index rising to its highest level since April of last year, up about 0.6% on the day, and that was really a move led by technology stocks. Those big Chinese technology companies listed in Hong Kong rallying about 4.25% when it comes to the Hang Seng Tech Index. And of course, that extends the rally we saw on last Friday before they closed for a few days for the holiday. Now, one story to watch, stock to watch, is Toyota, of course, listed in Japan. It was down about 0.6% in the Japanese session, but it was really after trading had closed that we got the big news. The idea that Toyota, of course, the current CEO is going to be chairman. He's the grandson of the founder of the company. Koji Sato is coming in to be the new CEO. We're going to have more on that in just a moment. But in terms of other Japanese assets, I would note the Japanese yen, a relative underperformer on the day against the U.S. dollar. It's weaker by about 0.25%. We're trading at 129.93, Matt.
Yeah, to me, the Toyota story is hugely exciting because Akio Toyoda has been really a rock for that company, and it'll be very interesting to see if he's really going to relinquish power. He's been very, very present in managing every aspect of Toyota's design and performance. So it'll be interesting to see what a new guy brings in. In terms of the U.S. futures right now, we are up 0.1%, and we've risen about 1% this week. We came up above 4,000 in the cash trade on Monday, and we've pretty much held there every subsequent day until now. So maybe we could break out a little bit higher. Right now, we're seeing futures up at 40.36. The 10-year yield, speaking of higher, moving up as investors sell the perceived safety of government debt. You add 3.25 basis points here to 347.44. So actually here, even though we see a big move, and if you look at today's chart, the one-day GIP looks pretty dramatic, but we really haven't gone anywhere this week. On the 10-year, we haven't gone anywhere this week on oil. Monday, we were talking about crude just over $80 a barrel, and today it's right there as well, so $80.69. It's a gain from yesterday's close of 0.2%, but we've been hovering around this level for West Texas Intermediate. And we've been hovering around this level for Bitcoin as well. Still at 23,000 all week. We've had some volatility in the late session yesterday or the early session today, depending on where you want to stop the 24-hour trade. We did jump up to 23,800. Now we're back down about 2.6% from there, but still at 22,985. Anna, what do you see in Europe?
Well, Matt, here in Europe, I can report general buoyancy on the equity story. We see European markets heading higher, and the more heavy weighting you have towards chip stocks, the better you're doing this morning. Financial services, retail, other sectors that are also moving higher. In fact, it's quite broad-based. We see most sectors in Europe in positive territory. So this is the picture across the map. We'll drill down into some of the individual corporate stories moving things around because they are of interest. Here's the CAC Caron, which does have quite a heavy weighting towards one chip stock in particular. Also, a lot of luxury, some of that not doing too bad in a generally positive risk-on mood. ST Micro, though, is a big gainer in the French market, also lifting the Italian market up by 5.6%, was up higher than that earlier, and lifting others in the chip sector as well. The numbers came in better than expected, and also they are suggesting they'll do better than analysts had forecast for this quarter that we're currently in, and all of that has to do with the strength in autos demand. I know we'll return to the auto story in a moment. Nokia, this is the telecom equipment company, that stock up by 4.4% as a result of their earnings, and this company company talking about robust demand in the sector, which is in contrast to what we heard from Ericsson. That stock really fell on the back of a sort of downbeat assessment of where consumers were and their customers were and their willingness to spend on those capital-intensive 5G projects. Diageo, this is providing some real downside to the European economy today. It weighs on the food and beverage sector, the maker of drinks, of course, and Diageo's weak spot seems to have come in North America. It was a fairly positive and buoyant Ivan Menezes, who I spoke to earlier on here on Bloomberg TV, talking about the business, but it was a further assessment, and the overall numbers seem to beat, but it was a further assessment of the North American business then, Matt, that has weighed on the stock.
All right, very interesting stories we're going to be watching in today's trade. We are also very much focused on automakers, as well as one specifically, Tesla, reporting better than expected profit in the latest quarter, even as the electric car maker gave mixed signals on the outlook for growth in production. Tesla says it's on track to deliver about 1.8 million vehicles this year, but the CEO, Elon Musk, says that outlook is just conservative.
If it's a smooth year, actually, without some big supply chain interruption or massive problem, we actually have the potential to do 2 million cars this year. We're not committing to that, but I'm just saying that's the potential.
For more, we're joined by Craig Trudell, Bloomberg Global Autos editor. And Craig, it's interesting. 1.8 million is a gain of only 37%. Only, I say. Should we be disappointed that they're only growing production by 37% a year?
I think we can take Musk at his word that really they were kind of lowballing with 1.8 million. 2 million does seem more likely, just given the amount of capacity that they brought online. I think they are still conservative in sort of where they say the ceiling is in some of their newest plants, and even in their plant in China, we've been reporting for months now that they think that they can crank out 1 million cars out of that plant, and they still haven't really increased their sort of stated capacity for that vehicle. For that factory in their quarterly results presentations. So, the question really is, just to what extent, there are some of those interruptions that Musk alluded to. Obviously, we've had a lot of supply chain challenges, that have hit the industry and have continued to drag on output for several years now. I think the other question is demand, right? There was talk on the call about, the concern about interest rates. Musk has repeatedly talked about the possibility of a recession this year. And so to what extent do they, maybe pull back on this 2 million ambition on the grounds that, they would have to cut price further in order to, to justify making that many vehicles this year?
Yeah, and Craig, it was also interesting to hear Musk say on the call yesterday that he thinks Tesla's biggest competitor is likely to be a Chinese company. Of course, as you just mentioned, Tesla makes its own cars in China, too. Its factory in Shanghai accounted for 52% of worldwide output last year. But all of that ties into today's big take, which explores China-made cars. The country is poised to become the #2 exporter of passenger vehicles, surpassing the U.S. and South Korea and risking new tensions with trading partners and rivals. So make sure to check out that story. Meanwhile, there's a lot of car stories, as we've said today, including Toyota, Craig. There's a change at the top. The Japanese automaker is promoting the Lexus president, Koji Sato, to replace Akio Toyoda as CEO. As someone who lived in Japan and has covered this extensively for years, Craig, what is your take on this move?
Yeah, I think Matt was absolutely right that Akio Toyoda really prides himself in being, heavily involved in every car. He, refers to himself as a master driver. We include a story about the new CEO, Koji Sato, driving actually in Lexus's first electric vehicle, and Akio and his head of Lexus, kind of, taking in that experience. You see, Akio in the beginning sort of talking about, this feels a little bit heavy. Let me press the accelerator here, and it's very clear that these two had a pretty close relationship. Lexus has been a success story for Toyota for some years in terms of the slow but steady expansion that they've done globally. And that's where the sort of, cutting edge of Toyota's fully electric vehicle push is going to come. We're going to see more of that on the Lexus side, I think, than on the Toyota side for the coming years.
Yeah, absolutely. The EV story there, one to watch. Craig, thank you very much. Bloomberg's Craig Trudell with the latest on the auto sector. Let's move to India now. India's Adani Group says it's exploring legal action against a US short seller, Hindenburg Research, after its report accused the company's firms of accounting fraud. Adani Group says the report was, quote, maliciously mischievous and unresearched. Bloomberg's PR Sanjay joins us once again from Mumbai. So some further, more strongly worded pushback, I guess, from the business.
Indeed, this is like very strong-worded, pushback, because yesterday Adani Group CFO himself came on the television. He had sent out a statement, and he had come on a video and circulated the video widely to say that this is all, malicious and malified intentions, etc. Today, Adani Group legal head also said the same thing, and he also said that they are evaluating legal actions against Hindenburg Research, and they are also setting up various calls with investors to allay the fears. And meanwhile, the FPO, which is launched yesterday to raise 2.5 billion, the anchor book has already subscribed yesterday, and in next few days it will also hit the retail investors. What we are picking from analysts is that there shouldn't be a problem for this follow-on issue, despite a scathing 100-page report from Hindenburg.
Yeah, I mean, I feel like research is the only thing Hindenburg does. So it's interesting to call this unresearched, and they've prepared this campaign for a while. Ed Ludlow has a great story about it on the Bloomberg terminal. How serious could these legal challenges be? I mean, Hindenburg certainly has been sued before.
To add to that, this is not the first time which Adani Group is facing such kind of things. Last year, another research firm, Credit Size, have also flagged the same thing, and they have also flagged that the conglomerate, the port-to-power conglomerate, could actually reach a possible default. So they had actually taken steps against this Credit Size, and they have watered down their stance. Of course, they had stuck to their original points, but now one will have to wait and watch what are the kind of illegal remedial actions in the US under US laws and Indian laws Adani Group will have to focus. But the most of the bandwidth of the management is currently focused on the current ongoing follow-on offer, which has actually invited interests like Maybank Securities and Abu Dhabi Development Investment Authority, etc. Some great 30 names have been disclosed yesterday to stock exchanges yesterday night. So it's one will have to wait and watch. It is a developing story, indeed an interesting story.
PR, thanks so much for joining us again. Bloomberg's PR Sanjay there reporting from Mumbai on this developing Adani Hindenburg story. We'll continue to bring you details on that. Now, in terms of the New York Stock Exchange trading snafu from a couple days ago, Bloomberg has learned that the NYSE, the mayhem there has been traced now to an employee who left a backup system running. That mistake triggered wild market swings involving more than 250 companies. Bloomberg's Danny Berger joins us now with the latest on how the disaster recovery system caused a disaster itself. Danny?
That is really some good irony. Look, this is a fantastic scoop here from Catherine Doherty and the rest of the team in New York. And essentially, there is this system, as you say, it's in Chicago, and it should be shut off and turned back on. For whatever reason, an employee there didn't properly turn it off. So the NYSE main system thinks that trading has just been running. So come 9:30, it just treats it like an extension of the trading day instead of saying, okay, trading is just about to start, we do the morning auction. Therefore, that morning auction simply does not happen. What does that mean? It means that this usually huge upswell of liquidity that happens in that morning auction isn't there. So anyone placing orders during this time is trading into a really illiquid market. It means that even if you just trade, let's say, 500 shares, it can mean that prices swing really wildly. And ultimately, the result is you perhaps lost or even made a lot of money.
Danny, what happens next on this one then? Because, we've seen a number of more than 1,300 trades and some 84 stocks were impacted. Some of that's being cancelled.
It certainly is, and there might be some financial repercussions of this as well for the NYSE. They do set aside $500,000 per month to deal with different issues. I mean, not this one specifically. I think this is one they probably didn't exactly see coming. But yeah, so they'll probably cancel some trades. But for the rest, for folks who have lost money and didn't have their trades canceled, they have filed some complaints. Again, it's not really clear how much money the NYSE will owe. Even Schwab criticized them too. They, of course, handle retail trades, saying that they are concerned that individuals might not get a fair shake in the outcome of all this.
Quite a story. Bloomberg's Danny Berger, thank you so much. Now let's turn to some other stories in the form of stocks moving in pre-market trading here in the U.S. And I want to begin with Chevron because it hasn't reported yet. Its results are due before the bell tomorrow. But yesterday it announced a plan to buy back $75 billion worth of shares. That is triple the previous authorization from back in 2019. So perhaps no surprise the stock is up about 2.5% before the bell. One stock moving down, though, is Wolfspeed, and moving down quite hard. This, of course, is a semi company. It reported yesterday its revenue guidance coming up short of expectations. It's feeling a little softness in 5G when it comes to some of those RF products. So as a result, it's down about 8.3%. And finally, I want to mention IBM as well. This is an interesting one because it did top expectations in the quarter they reported. The guidance also was pretty good. Analysts are really positive on the software business especially, but the stock is down about 2%. Also interesting to see the stock down because it announced job cuts. About 1.5% of its workforce it's planning to lay off. That's about 3,900 employees. We have seen in recent weeks, Anna, a positive reaction to cost-cutting announcements like job cuts from companies, but that does not seem to be translating through to IBM today.
Yeah, conversation we've had with a number of guests for how long can that be a positive driver for share prices. Coming up, we will put those kind of questions to our next guest, Coco Agublua, who is Societe Generale's Global Head of Economics, Cross-Asset and Quant Research. What difference a debt ceiling? We'll ask that question as well and talk about where the US goes, Treasuries, the Fed conversation and the earnings story. And we'll be speaking later on this hour with Ireland's new Finance Minister, Michael McGrath. A lot to discuss there as we see a downturn for big tech names, some of them very present in Ireland. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz in New York and Anna Edwards in London. Now, a slew of data is due from the U.S. this afternoon. Our markets reporter, Valerie Teitel, is here for a preview. Valerie, fourth quarter GDP is going to be the big number. What are economists expecting?
Yeah, it's the big number today. It's the first reading of the fourth quarter GDP. Economists in the Bloomberg median is for an estimate of 2.6%. Now, I'm going to keep an eye on the personal consumption component. This is what drew the upward revisions to the third quarter data as the consumer held in a lot stronger than we expected. Now, the fourth quarter covers the retail period. Let's see how the consumer handled it then. Also, keep an eye on the residential investment component. That drove the biggest drag on GDP growth in the third quarter. But let's not forget, we also get the quarterly PCE data. This is the Fed's favored measure of inflation ahead of the monthly print we get tomorrow. It's a broader basket of survey data, which is why the Fed prefers it. The estimates are for a drop to 3.9% from 4.7 previous.
OK, so there's a lot of data to watch out for. Of course, this data coming in our UK afternoon, Valerie, but in the morning, US time. US jobless claims, what are we looking for there?
Yep, there's also a drop at the same time, Anna, and the theme is quite pertinent here. We've seen some softening in the forward-looking survey indicators when it comes to the U.S. labor market, but it's yet to show up in the harder data. Jobless claims last week came in lower than expected, and this four-week moving average, that's its yellow line here, is on a downward trend. We're hoping for some cleaner data today now that we're past the winter weather discrepancies, and this is all ahead of the non-farm payroll report due next Friday.
OK, so all that data due 1:30 UK time, 8:30 of course, Eastern time. We'll look out for that. Thanks to Bloomberg's Valerie Teitel for the data preview and for an up-close look at these charts and all of the other charts featured during the show. You can check out GTV Go. That's the function to use on your Bloomberg terminal to find the charts that we use here at Bloomberg TV. This is Bloomberg.
Now, keeping keeping you up to date with news from around the world. Here's the first word. In Ukraine, President Volodymyr Zelensky thanked the U.S. and Germany for their promises to deliver tanks. The first of the German tanks could arrive within 3 months. Now Zelensky is calling for allies to provide other advanced weapons. He says Ukraine still needs planes and long-range missiles. The International Monetary Fund is urging the Bank of Japan to consider boosting flexibility in long-term yields. The fund says among the options are raising its 10-year yield target and widening the yield trading band. The IMF sees more upside risks to inflation as the yen's decline makes imports more expensive. Meta Platforms is reinstating former President Trump's Facebook and Instagram accounts after a 2-year suspension, of course, post-insurrection at the U.S. Capitol in January 2021. His accounts will be subject to what the company calls guardrails, and there will be specific penalties for rule breaking. The former president was reinstated on Twitter back in November, but hasn't posted there yet. And there's a growing push in Congress to completely ban Chinese-owned TikTok in the U.S., raising the stakes for the Biden administration. The government is in the late stages of reviewing the security risks of the popular social media app. Republican Senator Josh Hawley has introduced legislation to prohibit TikTok, saying it would allow China to access personal information. But I can't imagine that would go over all too well with Gen Z. Coming up, though, we'll turn our eyes away from social media back to the broader markets and macroeconomics. Koku Agboola, SocGen's global head of economics, cross-asset, and quant research, joins us next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Tesla ramps up production after reporting better than expected profits. Elon Musk's electric car company plans to deliver 1.8 million vehicles this year, a 37% increase. Asia's richest man fights back. The Adani Group considers legal action against the short seller who accused the billionaire's empire of market manipulation and fraud. And the culprit in the chaos at the New York Stock Exchange? Well, Bloomberg's learned it was a staffer who left a backup system running when it should have been shut down. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Maybe we can put that one behind us. Let's hope so. Matt, as we head towards the start of US trade, maybe things fading a little bit. Waiting for a lot of data, though, at the beginning of the US morning.
Yeah, we are. Just about 3 hours to go until we get U.S. GDP and then a slew of other economic data that we're all going to be combing through. Definitely don't want to miss that. In terms of futures right now, we're up about 0.1%, and it's been a decent week. I mean, we're up back over 4,000 in the cash trade. We've gained about 40 points since the open on Monday. So if we hold there, we could see the risk on feeling pervade throughout the market. We're basically right where we were in terms of a lot of the other price action. The 10-year yield still at 3.47, and it has been pretty much all week. The NYMEX crude quote still at $80.89, but it's been just above $80 all week. And Bitcoin still at $23,000. It's been there. So we're waiting for some kind of catalyst, I guess is what I'm saying, to move these markets. And if we get real divergence from expectations in GDP or any of the economic data, that could drive us, because it's the Fed really that seems to rule everything, Kailey. Not so much earnings, although I'm sure that's moving some of your pre-market movers.
Yeah, definitely. Specifically from Tesla, because it is a relatively heavy weight within the U.S. equities. So that's why you're seeing the NASDAQ 100 futures outperforming S&P 500 futures, because Tesla is moving pretty substantially in pre-market trading, up about 7% after its results. Profit topped expectations. The company is also boosting output, plans to deliver 1.8 million cars this year. Investors seem to be taking all of that pretty well, and it's having a positive read-through as well to some of its rival EV makers. Lucid, Rivian, each up about 3.2% before the bell. One stock moving lower, though, is IBM, despite the fact that it beat expectations, despite the fact that its forecast actually was pretty good. Analysts seem positive on the software revenue stream especially, and it's laying off 3,900 employees, about 1.5% of its workforce, which what we have seen recently is layoff announcements tend to have a good positive leading move for the stock, but that is not the case for IBM this morning. It's down about 2% before the bell, Anna.
So, Kailey, European equity markets then, compared to the US, maybe a little more positive, although that NASDAQ outperformance worth a mention. Stocks Europe 600 up by 0.5% this morning, and we are seeing some response, talking of catalysts, to some individual earnings stories. They are cutting through this morning. STMicroelectronics, the chip maker, up by 6.3%. That's lifting the CAC on, lifting the FTSE MIB over in Italy as well. And they came through with numbers that look to be better than expected in the rearview mirror, if you like, but also talking positively about revenue estimates for this quarter, beating estimates there, if you can put it that way. And as a result, the stock goes higher, up by 6.3%, as I say. And this to do with the car sector and demand being strong from the car sector. Nokia is a telecom equipment manufacturer, up by 3.7%. In contrast to what we heard from Ericsson, this business saying that their customers, who are, of course, those big telecom companies that spend on 5G, they see robust demand. In contrast, as I say, to Ericsson, which gave us a much gloomier picture. Diageo, I spoke to the CEO earlier on. He was sounding quite buoyant, quite bullish about the state of the global consumer. And the overall numbers did seem to be on the right side of estimates. But it was a deeper dive into the North American part of the story, Matt, that resulted in the stock selling off, down by 6.8%.
All right, well, we'll continue to watch those movers. Joining us now to talk about the market more generally is Kokou Agboola, Global Head of Economics, Cross-Asset and Quant Research at SocGen. Kokou, you know, I was just talking about the fact that the markets don't really seem to be moved too much by earnings. It's really the Fed narrative. If you think the Fed's going to continue hiking and hold, or if you think the Fed's going to be forced to pivot, that seems to inform strategies around the world. What's your take?
Well, I think our take is essentially twofold. Number one, we think the Fed will continue to raise interest rates and then pause at 5 and 5.25%. And in Europe, I think the ECB is probably going to go higher than what is priced by the market at roughly 3.75 and then stop pausing. One of the things to bear in mind is that it takes 3 to 5 quarters for interest rate hike to hit the economy. And today we have a bit of a cognitive dissonance between what the yield curve is pricing, i.e. a sort of imminent recession, and then the Fed starting to cut interest rate in the second half of the year. And then the sort of very resilient earnings story, non-farm payroll, and also core inflation that is pretty strong, even though headline inflation is essentially rolling over. So the problem is that we are a bit in the eye of the storm, hence the sort of lower equity realized volatility that you're seeing today. Because on the one hand, valuation and multiples have been hit by the strong rebound in yield that we saw last year, but we are yet to see the earnings recession that is supposed to bring us into a recession. And this is simply because of inflation. You have 10% headline inflation. A lot of companies have been able to pass that on to the end consumer. And that's ultimately offsetting some of the lower volume growth that negative volume growth that we're seeing in some sectors. So net, it's more of a wait and see mode.
OK, so wait and see. And a complicated picture you described, Kokou. Does that suggest then that stock markets, as it stands, having not priced in an earnings recession, are sort of pricing in a soft landing, whereas bond markets are pricing in a harder landing? Is that the situation we're in now?
Yeah, that's correct. It's a good way to summarize it. So which means the following. So either we see core inflation starting to ease, or we see core inflation continuing to rise and be sort of sticky, in which case the Fed will have to raise interest rate by more than what's priced in by the market. And that could get us out of this sort of low realized volume environment and essentially maybe a repeat of 2022 in a way, because that will cause a repricing valuation.
A repeat of 2022. Hang on a second, Kokou. Does that mean you think that there is the possibility then that stocks and bonds all lose ground this year, and we're back to that story of sell everything?
Well, particularly when you think about China, because here's the very interesting situation, because China has done something that Western economies or societies wouldn't have dreamed of doing, is after 900 million people getting COVID over a matter of weeks, they've managed to reopen the economy. Obviously, there was a significant death toll attached to that. But that, in our opinion, is going to raise GDP by roughly 2.5 to 5.3% this year. And that means it will help global growth and lower the risk of a recession. The question is, what is the impact on inflation globally? And is that going to force central banks to raise interest rates by more than would otherwise be the case? And this is some of the questions we are wondering, because if global core inflation is boosted upwards, driven by China and some of the commodity consumption that will obviously increase, then we are back to square one, and we could see some of the volatility we saw in 2022.
So, Koku, with that in mind, how great is the risk that once the Fed reaches the currently understood terminal rate and holds there for a while, that the next move is not a rate cut, but potentially a rate hike if we do see that refueling of inflation?
Well, I mean, that risk is growing, and this is why I've mentioned earlier the sort of dissonance between what the yield curve is pricing, what the Fed is actually saying, so, mentioning that tightening is required to bring inflation back to the 2 to 3% level, and the market sort of assuming that the worst is behind us. And I think that if you look at the distribution of outcomes, this is probably the area to worry most for investors to pay a lot more attention to.
Koku, thanks very much for your time. We appreciate it. Koku Agbu-Blower joining us there from Societe Generale with his views on the markets. Coming up, we will take the temperature of the Irish economy. We'll be speaking with Ireland's new finance minister. Michael McGrath joins us shortly here on the programme. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, an interview with Blackstone President and COO John Gray. That's at 8:30 a.m. New York time, 1:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz over in New York. Now, we've talked a lot about the tech industry recently, the earnings reports coming through from that sector. One feature of that has been job cuts, a wave of job cuts across the tech industry. It's a particular concern, perhaps, in Ireland and for its finances. We've heard from Meta, Twitter, Amazon and Alphabet, and many businesses in the sector cutting back on jobs. So what is at stake for Ireland? Joining us now is Ireland's new finance minister, Michael McGrath. Very good to have you with us, Minister.
Thank you,
we'll
Anna.
start with the tech sector because it is a big part or a decent part of the Irish story, and then broaden our conversation from there. So we hear about all these job cuts in the sector. How concerned are you on that front?
Well, of course, the tech sector is very important to the Irish economy, and when we hear of any of these announcements of layoffs, our first thoughts are with the employees and those who are going to lose their job. And in Ireland, we always do everything we possibly can through our state agencies to assist those workers to find alternative employment. And so we are engaging with all of those companies at this point in time who have made announcements. Of course, it is a global phenomenon. Many of them have a large presence in Ireland, and we are seeking to establish what will be the exact impact on their Irish operations. But the indications are that the impact on Ireland will be in line with, or perhaps less than that, with other countries where these tech companies have a presence.
Okay.
They've all reassured us of their absolute commitment to remaining in Ireland. They've had a very, very good experience of operating in Ireland, and all have had really positive things to say about the talent, the pipeline of really educated.
Okay, so they continue to be positive on the Irish story. Looking at some research from Goodbody, though, they seem to be worried about not just the job story, but also the tax take that Ireland will get from the tech sector, and maybe even the FDI story, the foreign direct investment story into Ireland, if we're seeing tech profits so under pressure. Do you share those concerns?
I think it's too early to say. The tech sector is an important contributor to the Irish economy in terms of income tax receipts, because they provide really good, well-paid generally and high-quality employment, but also in relation to corporate tax receipts in Ireland. But I think it's about putting this into perspective as well. The tech sector in Ireland will still be larger even after all of these layoffs are implemented compared to what it was pre-pandemic.
Okay.
And our Inward Investment Agency continue to be confident, notwithstanding the challenges, the global headwinds that are undoubtedly there, that the tech sector in Ireland will remain very, very strong. So there will be an impact. It's difficult to quantify at this point in time, but of course we have strengths across a whole range of sectors, including life sciences and so on.
Kailey, jump in.
So, Minister, if we could continue the discussion on taxation more broadly, how much progress is being made on the discussions around the outstanding parts of the OECD tax deal, and when do you anticipate that will be ratified by a critical mass of countries?
Hi, Kailey. So Ireland signed up to this deal, as you know, in October of 2021, which was a very significant decision by the Irish government, and there are two pillars to it. Pillar 2, of course, relates to the new minimum effective rate of tax of 15%, and that cleared all the hurdles within the European Union in December just gone. And so I expect now to be bringing forward legislation in Ireland this autumn in our annual finance bill to give effect to that, and the new 15% rate for very large multinationals with revenues in excess of €750 million will take effect on the 1st of January 2024 in Ireland. Of course, Pillar 1 is quite different, relating to the reallocation of taxing rights. That is being dealt with at a global level through the OECD. Ireland is very much involved in the discussions that are taking place, which are complex and technical, and I think it's difficult to be certain about the timeline of a conclusion for those talks, but I think it's important that we do provide certainty globally to how some of the largest multinationals in the world are taxed.
And Minister, amid other conversations that are ongoing, include those around the Northern Ireland Protocol, how would you characterize your conversations with the Chancellor this morning around that? Where did you leave things?
Well, it was my very first meeting with the Chancellor, and so it was about getting to know each other, and we have very good relationships, of course, between the UK and Ireland, very deep historical, cultural and political ties. And the Chancellor and I did discuss the ongoing negotiations in relation to the protocol. We respect very much that these negotiations are being conducted by the European Union on behalf of all of the member states of the EU, including Ireland and the United Kingdom government. But we both underlined our commitment to achieving a resolution. It is in everybody's interest that an agreement is reached which resolves the outstanding issues with the protocol, that secures all aspects of the Good Friday Agreement, keeping an open border on the island of Ireland, protecting absolutely Ireland's place within the single market, and of course ensuring that we have free-flowing trade east and west between GB and all parts of Ireland. That's our objective, and I am hopeful that we will reach a settlement over the period ahead.
Mr. Minister, if you can excuse an ignorant American's questions about reunification. What's it been, 100 years now and change since the Anglo-Irish Agreement, since the island was partitioned? How much longer is Ireland going to remain divided? I mean, the best open border would be one united Ireland, wouldn't it?
Well, of course, it remains a legitimate political aspiration for many of us in politics to achieve United Ireland at some point in the future. But we have a Good Friday Agreement, which will be 25 years old actually in April of this year. And of course, the United States played such an important role in the achievement of that peace agreement. We have democratic institutions in Northern Ireland that currently are not operating, and reaching agreement on the protocol could unlock that situation and result in the Northern Executive being re-established, the Assembly, the representatives elected by the people of Northern Ireland meeting to deal with all of the issues that affect the people there on a day-to-day basis. And of course, there is provision within the Good Friday Agreement for the calling of a border poll by the Northern Secretary when the assessment concludes that the conditions are right. But we do not anticipate that that will be happening in the very short term. For now, the priority is reach agreement on the protocol, secure a final settlement in relation to what is an outstanding issue relating to Brexit, and get the democratic institutions in Northern Ireland up and running. That's where our short-term priorities lie.
Yes, and the focus on the Northern Ireland Protocol with all of that in mind. So you say that progress, it was the first meeting with the Chancellor and that things seem to have gone well, but when can we expect to see progress, do you think? When will we actually get real progress on the Northern Ireland Protocol?
Well, the negotiations are ongoing, and they are intense. And they are complex, and they are technical, and the most important thing here is that we get the right outcome. And from the Irish government's perspective, we will be as supportive as we possibly can be, and we think it's important that we allow those who are doing the negotiations the necessary time and space and the freedom to reach an agreement. So we are hopeful that in the coming weeks, but we cannot be certain of that, that there will be progress, and we'll do all we can to facilitate and support that process.
In the coming weeks. OK, Minister, thank you very much. Thanks for joining us. The Irish Irish Finance Minister Michael McGrath speaking to us here in London. Now, coming up on the programme, crafting a succession plan. Recent management reshuffles at the French luxury group LVMH have fueled speculation about the billionaire CEO's replacement. We'll have the latest next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now let's take a quick look at what is coming up for the rest of this Thursday. We'll be getting more earnings from American Airlines around 7 a.m. Eastern. Then at 8:30 a.m., a slew of U.S. economic data, including fourth quarter GDP, durable goods, and initial jobless claims. Then later, more earnings. Intel is set to report after the closing bell. And after the European market closing bell, we'll get LVMH earnings. The luxury retailer's fourth quarter performance in China will be of particular interest, Matt.
Yeah, absolutely. We'll be paying very close attention to that. Let me get to, though, a management reshuffle at the helm of LVMH. It has fueled speculation about billionaire Bernard Arnault's succession plan as well. Caroline Conan has more from France.
There's no better place than Cannes on the French Riviera to talk about luxury and its biggest empire, LVMH. The group's fashion brands, Christian Dior, Louis Vuitton or Givenchy, are regulars on the red carpet, along with jewelry makers Bulgari and Chaumet, while Moet or Dom Pérignon champagnes are often flowing behind the scenes. In total, LVMH counts 75 luxury brands. The founder and CEO of the French conglomerate, Bernard Arnault, became the world's richest man last month, after the net worth of Tesla's Elon Musk tumbled. Bernard Arnault can stay at the helm of his luxury powerhouse until he's 80, after the company lifted the maximum age of its CEO. But over the past few years, he's been carefully crafting his succession plan, slowly elevating his 5 children to bigger roles. His only daughter, Delphine, has just been named CEO of the couture brand Dior. His eldest son, Antoine, now runs the Christian Dior family holding, which controls LVMH. The third child, Alexandre, has been a vice president at jeweler Tiffany, which his father acquired during the pandemic for $16 billion in the most high-profile luxury M&A saga. Then you've got Frédéric, who runs the Swiss watchmaker Tag Heuer. And the youngest one, Jean, 24 years old, is developing Louis Vuitton watches. All 5 of the billionaire's heirs are vying to take over their dad's luxury empire. And incidentally, Europe's most valuable company.
Bloomberg's Caroline Conan reporting on the important story that is LVMH. And Kailey, I was just looking at the performance year-to-date of some of these businesses. LVMH year-to-date up more than 17%. Burberry in the luxury sector up 17%. Richemont up 16%. The reopening of China certainly putting a fire under this particular European story.
Yeah, the idea that the Chinese consumer may be feeling more confident and, frankly, just more free to go out and shop for luxury goods, that we know that that is a driving force for this sector, and as a result, a large driving force for European stocks as well, Matt. It seems that China reopening story has changed so many different components of the market narrative in really just the last couple of months.
Yeah, China's such a huge piece of luxury demand. It'll be interesting to see what happens if we go into recession, which is now expected to be milder in Europe. That's good for luxury, but also, of course, people who can afford these things typically don't tighten their belts as much as the rest of us during a recession, do they?
Yeah, the bifurcation of the consumer, if you can put it that way, is certainly a talking point here. The way that some consumers really affected by cost of living challenges, higher energy costs, for example, and others less so, of course. Now, that is it for Early Edition. Surveillance is ahead. Tom, John and Lisa will be taking you through the market moves. They'll also be speaking to John Gray, President and COO of the Blackstone Group. Lots of interesting conversations still ahead. This is Bloomberg.